What is going on, everyone? Welcome back to the podcast. My name is Colin Hayes. I am your host of Financial Planning for those retiring in 5 to 10 years. And in today's episode, I want to talk about something that I think a lot of investors maybe overlook. And that is the actual cost of owning an investment. And when I start talking about investment costs, you might immediately think about the fees. Right? You might say, okay, yeah, I know there's a cost of a mutual fund or an ETF known as the expense ratio, and it cost me 0.50% or 0.25% or 1.03%. That is the expense ratio of a fund. And while that is important, there's another cost that I think gets overlooked quite a bit, especially when I'm talking about investments held within a taxable account. And that cost is taxes. And I want to talk about why an investment on paper can be perfectly reasonable on its own, but potentially might not be the most tax efficient investment to hold in a taxable account. So if you ever looked at a mutual fund or an ETF, you go on Google Finance and you type in a certain ETF or the ticker symbol for that ETF or mutual fund, you've probably seen an expense ratio. An expense ratio is essentially just the cost or the annual fee that the mutual fund company or ETF company charges to cover its operational and management expenses. It's expressed as a percentage of assets that you have in the fund. And it's important because you don't get billed for this. It's not like, at the end of the year, you see a thing on your statement that says, you paid this much in expense ratio fees. Instead, those expense ratio costs are just reflected in the fund's returns. So let's say, for example, you had $100,000 in a fund that had an expense ratio of 1%. That's $1,000 per year in the fund expense cost, the expense ratio cost. Of course, your value is going to fluctuate, so it's not exactly $1,000, but we're just going to assume for the example, $100,000 in the entire year, 1% expense ratio, that's $1,000 in fees for that year. If the expense ratio was 0.50%, that's $500. And if the expense ratio was 0.10%, that's $100. And what's important about this is it matters. Cost matters. And over many years, the differences that you're paying in fees versus saving in fees, if you had a lower expense ratio, can and does compound over time. But I don't want you to take away from this that a high expense ratio is bad or expense ratios are bad, period. Funds, ETFs, mutual funds, they have expenses and you're paying for the management and the operation of the fund. So it's not that expense ratios are bad, but the question is whether the cost, the expense ratio, the higher fee is reasonable for what you're getting. It can be a great idea to look at a mutual fund or an ETF that you have that maybe has a high expense ratio fee. Can you find a replacement that is a lower expense ratio? A similar fund that could probably produce potentially similar returns, but the expense ratio is less. The question is whether the cost is reasonable for what you're getting. But expense ratio isn't the only cost. Let's say that you found a mutual fund with a reasonable expense ratio. And you look at it and you're like, okay, this is fine. The expense ratio is in the range that I'm okay paying. There can still be another cost that you need to think about, and that's taxes. And this is especially important when you're talking about a taxable brokerage account, not an IRA, not a Roth IRA, not a 401k or a Roth 401k or a 403b or Roth 403b, but a taxable brokerage account. Because not all investments are equally tax efficient, and not all accounts, traditional Roth, taxable brokerage account, are taxed the same way. So what I talk about next, I want to pick specifically on mutual funds, not ETFs, but mutual funds. So when you buy a mutual fund, you're pooling your money in with other investors. The fund itself then owns a portfolio of investments. This could be stocks, bonds, other securities. And then the fund manager of the mutual fund, it's a real human being, can buy and sell those investments. Obviously, there's a guideline within that mutual fund, and you can find this on the fund prospectus. What's the goal of the fund? What type of investments do they buy? What's the stock to bond ratio, et cetera? You can find all this. But the fund manager can choose to buy or sell certain investments. And if the fund sells an investment that has appreciated, the fund may realize a capital gain. Then that capital gain can be distributed to you as the shareholder. And if you're holding that mutual fund in a taxable account, that distribution can create taxable income for you in the current year. And I get what you're saying. Whoa. I myself didn't sell the mutual fund, but within the mutual fund, the fund manager was buying or selling things for gains. So I didn't sell anything. So why am I having to pay the tax? And this is probably the part that surprises people most with mutual funds. At the end of the year, if there are capital gains paid out to you, you will get a tax form and you'll see a capital gains distribution from a mutual fund. And maybe you've had this happen in the past and you'll say, whoa. Again, I didn't sell any of my shares. I actually maybe even bought more. And that's true. You didn't sell your shares of the mutual fund, but the mutual fund itself may have sold investments inside the fund. So even though you didn't personally sell your shares, the activity inside the mutual fund can result in a capital gains distribution to you, which is taxes that you have to pay even though you didn't sell. And that is an important distinction. Let's say you invest $100,000 in a mutual fund, and the fund owns a bunch of different stocks. Some of those stocks have gone significantly up over the years, and the fund manager decides to sell some of those positions. Those sales create realized capital gains inside the fund, and then the fund may distribute some of those gains to the shareholders, those that own shares of the mutual fund. This doesn't mean that the fund is bad, because the underlying investments might have legitimately appreciated. But the point is that taxable activity inside of the fund can create taxes for you. And because it's held within a taxable brokerage account, that means each year you have to pay taxes, even though you didn't sell, on those gains, on those capital gains distributions. Now, I want to shift gears and talk about something that's called tax efficiency. And that's the bigger concept of this episode that I kind of want to focus on. When I say tax efficient, I'm not saying an investment that doesn't create any taxes. Because if you buy something and it goes up inside of a taxable brokerage account, you will at some point pay taxes on those gains. But I'm talking about how much taxable income or taxable activity does an investment tend to generate relative to the return that you're getting. Some investments can be relatively tax efficient. Usually ETFs or exchange traded funds are tax efficient from a capital gain distribution side, but others can be relatively tax inefficient. A mutual fund can be a perfectly reasonable investment, but it might not be the most tax efficient thing to hold inside a taxable brokerage account. With your IRA or your Roth IRA, those capital gains distributions that are paid out at the end of the year with that mutual fund, you're not paying taxes on those. But with a taxable brokerage account, you are. And that's where the type of account starts to matter. So I'm building off tax efficiency. I talked through capital gains distributions and expense ratios, and then the tax efficiency versus tax inefficiency. But now we're talking about the type of account and why this starts to matter. And this is where I think financial planning, what I do as a financial planner myself, gets really interesting. Because we often talk about asset allocation. You've probably heard that. Maybe if you have an advisor, they've talked about asset allocation. And that's essentially how much of different assets or investments should I own? How much in stocks? How much in U.S. stocks, non-U.S. stocks? How much in bonds? How much in non-U.S. bonds? How much in cash? Asset allocation. But there's another question. where should I own them? That question is asset location. You might have a taxable brokerage account. You might have traditional accounts like a traditional IRA or traditional 401k. You might have Roth accounts like a Roth IRA or a Roth 401k. Each of these accounts have different tax characteristics. So you don't necessarily want to look at each account in isolation. You don't want to just look at your Roth accounts over here, then your traditional, then your taxable in isolation. We want to look at the entire picture. So the building block of this would be question number one is, what investments do I own? Then it would be, okay, what are the tax characteristics of those investments? And then I would ask which account makes the most sense for each type of investment. So let's say you have two investments. I'll give you an example. Investment A generates a significant amount of taxable income and capital gains distributions each year. Investment B is way more tax efficient. Well, you might not want to necessarily hold both of those investments in the same place. Because if you're holding something in a taxable account, you're dealing with the tax consequences as they occur. Whereas retirement accounts, income and capital gains distributions are not taxed annually. So this becomes now a financial planning question, an overall planning question. It's not just what is the best investment. It is what is the best investment for this account and for my overall situation. So I know I talked about a lot of different things today and gave many examples and things to think about. So now you might be wondering, what do I look at? What should I actually look at when picking an investment? Here's just a couple things, 5 things. The first thing is to look at the expense ratio of the fund. Higher does not mean worse, lower does not mean better, but it is good to see and look to make sure that you're keeping control of your expense ratio costs. Number 2, if you're looking at a mutual fund, look at the fund's historical capital gains distributions to get an idea of what you would pay if it was held in a taxable brokerage account in taxes each year. Number 3, look at the fund turnover. Fund turnover, if it's a high turnover, that means on a yearly basis, that fund manager is buying and selling many things. And if those investments are for a gain, because it's a high turnover, that capital gain might get kicked off to you to pay taxes. Number 4, understand the dividend and income characteristics. What are the dividends of this fund? Because if it's held in a taxable account, you're going to pay taxes on those dividends. What are the different income characteristics? Again, if it's held in a taxable account, you're going to pay taxes on the income generated. And number 5 is to think about the account that you're holding this investment in. If it's a taxable brokerage account, it's a good idea to hold tax-efficient investments. If it's inside an IRA or a Roth account or another retirement account, you have a little bit more flexibility. So those are just a few things to look at when picking an investment. Now, the next thing I want to talk about is just a few misconceptions. People might say, okay, well, I'm hearing all these things. What are some things that I've heard that are misconceptions? Number 1, I've said this a lot in this episode. A low expense ratio does not mean it's automatically the best investment. Cost of owning the fund is important, but it's not the only factor. It's only one factor. Number 2, I've heard someone say, well, if I didn't sell anything, I don't owe taxes. And that's not necessarily true. Mutual fund capital gains distributions can create a taxable income event even when you didn't personally sell your mutual fund shares. That is specifically when held inside of a taxable brokerage account. Number 3, a misconception I've heard is mutual funds are bad. That is not what I'm saying. Mutual funds can be a useful investment vehicle, but it's important to understand, if you're picking a mutual fund, to understand the costs and the tax characteristics of that fund. And number 4, a misconception I've heard is, well, tax efficiency doesn't matter. But it can. It can matter. And when you're talking about a large taxable portfolio and many years of investing, the tax drag, the costs involved, tax efficiency does matter. This episode is a good example of why financial planning is more than just picking investments. Because you can have a good investment or a good portfolio, but you still have to think, how does everything work together? What are my investments? What accounts do I have? How are those accounts taxed? What are my current income and tax circumstances? What are my future income needs? How do all these pieces interact? And that's where financial planning comes into play, helping you coordinate all the pieces together. So if you were to take away 3 things from this episode, number 1, understand what you are paying. Do not ignore expense ratios. Number 2, understand the tax characteristics of your investment, especially when you're holding them inside of a taxable account. Number 3, think about where you're holding your investments. Don't just think about asset allocation. That is important, but also think about asset location. Because sometimes the question isn't what is the right investment? It is where is the right place to hold this investment within my overall financial plan. At the end of the day, I don't think investing should be about trying to find the perfect investment. Yes, you want good investments that will do well, hopefully over your lifetime. That is the engine of your financial plan. But it's understanding what you own, understanding what it costs, understanding the potential tax implications, and understanding how those investments fit into the rest of your financial plan. Because a return on your statement is one thing, but what you actually get to keep and use towards your goals is another. Thank you so much for listening, and I'll see you in the next episode. Goodbye. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. Investing in mutual funds involves risk, including possible loss of principal. Fund value will fluctuate with market conditions and may not achieve its investment objective. ETFs trade like stocks, are subject to investment risk, fluctuate in market value, and may trade at prices above or below the ETF's net asset value. Upon redemption, the value of fund shares may be worth more or less than their original cost. ETFs carry additional risks such as not being diversified, possible trading halts, and index tracking errors. Asset allocation does not ensure a profit or protect against a loss. The examples in this episode are hypothetical examples and are not representative of any specific investment. Your results may vary.